Morning. If you guys just verify you can hear me and see me, that'd be great. Wait a minute for Danielle to come on. Good morning, Danielle. How are you?
Morning. I'm good. How are you?
Excellent. All right, guys. Today we're going to be going over the earnings of Intel and Google. And now, if you do not invest in Intel and Google, it doesn't necessarily matter. What we're trying to look at is this bigger AI picture, how it's playing out, what's going on, and what's causing the market to really sink right now. A lot of it has to do with geopolitical events, right? So you have this war that started on February 27th, and it's been going on, and now we're end of July, still going on. And there's really no end in sight. And that keeps causing oil prices to remain elevated. Oil prices remain elevated, that means we have an inflationary issue. Inflationary issues means potential rate hikes. That is not good for the general economy nor the stock market. So that's the overhang we're working with. If that dissipates, if that goes away sometime soon, we're going to be in a pretty good spot. But there's no guarantees that's going away. Now, shifting back to the likes of Google and Intel, what's going on with them? Well, we're going to take a look, and Danielle, if you wouldn't mind just zooming in on so everyone can read it. What's going on with Intel and Google? What the main picture is, it's going to be capex. Capex, and I want to give you something about capex before we get into the details here. Okay? CapEx is capital expenditures. So when companies make a profit, and Google made a great profit, they beat on every single metric possible. Top line, meaning revenue, earnings, everything, earnings per share. They beat on every single metric, and the stock got beaten down. Why is that? Well, CapEx is your capital expenditure. How much money are they investing for future growth? Now, when you make a profit, you have a few things you can do as a company. You can say, hey, we're going to take this money and we're going to buy back our shares, therefore reducing the number of shares, and then the earnings would be earnings per share would actually increase because there's less shares to divide those earnings by. That's one way. Next thing you can do is you can increase your dividends. Google does pay a dividend. Okay, so you can increase your dividends. You can do those things. Now the other thing is you can spend on R&D or capex. Okay. Now these companies, the hyperscalers, the Mag Sevens, they are spending incredible sums of money on capex. In fact, they are spending so much money on capex that they're exceeding their free cash flow. And why is that a concern? Well, let's take a look at the example of Meta. Meta, and I'm going to give you another example of Apple. Okay, so Meta has spent tens of billions on the metaverse, VR, headsets, the whole Meta universe. They spent tens of billions on it. I'm actually might be over 100 billion already. I'm not quite certain the exact number, but they spend incredible sums of money on it. It's yielded no return. Okay. So what the market's saying is, hey, you're spending all this crazy amount of money on this metaverse, and it's done nothing. Apple spent $10 billion on this electric vehicle that they wanted to produce. Okay. Nothing. Now the question as a whole now also exists. Well, all these companies like Alphabet are spending crazy sums of money on capex, capital expenditures. Now they're spending for future growth, but that future growth, as we looked at the examples of Meta and Apple, don't always come to fruition. And if they don't come to fruition, well, what does that mean? Well, that means this money might be sunk. And the stock market's saying, well, hey, you're spending tons of money, more money than you're making, in fact, on capital expenditure. What happens if it doesn't work out? All this money is down the toilet. Now, the other derivative companies from there, like the Microns, the SanDisk, um, they're making a killing off this because they're benefiting from it. Intel, uh, Nvidia, they're making a killing off all this capital expenditure. And it kind of trickles down the line. Okay. Those companies spend money, then they have to buy stuff like cooling stuff, which is Vertiv, cooling in order to cool the chips down. Energy has to get purchased. It's Constellation, for example, G Vernova, things like that. So it's a trickle down effect. But who's taking it on the chin? Well, who's taking on the chin right now is the Magnificent Seven. And the reason they're taking on the chin is because they have all this spend. But the market says, hey, look, I don't know if you're going to benefit from all this spend yet or not. We don't know. And we're going to peg you down here a little bit. So Daniel, let's get into earnings and let's look at the good. And let's take a look at also all the CapEx spend. Okay. And what I was particularly impressed with Google was their cloud growth. Okay. Now, Google is the number three provider globally of cloud storage and cloud services. They had a massive rise in cloud revenue. Now, that could be one of the early signs that all this capex is starting to work out for them. Okay. So, Danielle, let's get into Google's earnings and let's take a look because this is going to give us a window into the bigger AI play.
Yeah, so I'll start with Alphabet's earnings. First things first, cloud growth was very impressive, but not everything was very positive. So adjusted earnings per share were lower than estimates. Although, if we see this page here, Alphabet's earnings were 9.11, but those
Oh,
were
there's a
unadjusted.
one-time item.
That's
There
a
was a
one-time
one-time
thing because it earned
97
it
billion.
earned 97 billion worth of income through its other income line. Otherwise, adjusted earnings were lower than estimates, and that was the first flip in the overall earnings of Alphabet that concerned investors because they are investing so much, and if in operational wise, if they are not beating expectations, obviously it's not gonna be a good thing for Alphabet. However, on the revenue front, it did pretty well. Um, there were two concerns basically as far as Alphabet is concerned. One is CapEx and the other is where's the return on investment? However, Alphabet's cloud segment grew phenomenally. If
Well,
you
it's on the
see,
first. Yeah.
if you
So let's
see,
take a look. So they're spending a lot of money in this cloud growth. Okay,
yeah,
AWS is, Microsoft is, and Google is as well. They grew this quarter. Okay, from the prior year, 82%. If you want to highlight that last second last paragraph just above this chart, Danielle, shareholders have wanted to see strong revenue growth in the company's cloud business for reassurance. It justifies the heavy spending. Alphabet seemed to deliver on that count. Second quarter Google Cloud revenue rose 82% from the prior year, far ahead of the analyst estimate of 63%. So we know that cloud growth is getting there. Now, Daniel, do you want to describe exactly what the hell is this cloud and why does it matter?
yeah. Basically, it's explained here, and I'll just read this part and I'll explain it further. Cloud is Alphabet's cloud computing and artificial intelligence service that allows clients to rent server space. Okay, so basically, if I'm like working and I want to store a lot of data, the first option that I like people used to have prior to cloud was store data in their own hard drives. But that hard drive has a limited capacity. Now, what cloud has done is you can buy a subscription of cloud and you can store data in cloud. And this data is basically stored in Alphabet or Amazon or Microsoft's servers. So basically, you don't have to own more hard drives. You can just purchase their subscription and save data in the cloud in their servers. And that's protected. It's not like that data wouldn't be used anywhere else. There's an agreement that you do with that company that your data and everything would be protected. So that's basically cloud. You rent space to store your data. In simple terms, that's cloud. And right now,
Yeah, now
cloud
a lot of the smaller businesses, they're not going to have their own cloud division. So what they're going to do is they're going to rent this space. They're going to rent the space so that they can have their data there so they can train their large language models, i.e. their artificial intelligence. So if you're a smaller company, you simply cannot afford it. You're not going to have your own cloud business. You'll rent from the likes of Amazon Web Services, from Google, and from
Microsoft.
Microsoft. You'll rent from these companies, okay? Now, Google saw an 82% increase in this business year over year. So that means that even the smaller companies now are starting to develop an artificial intelligence presence within their business. That is a very, very good sign. And this is the main driver. Like YouTube is a great business, okay? But it's not going to see this sort of growth. The search engine, great business, but not going to see this sort of growth. This is the main driver of growth, and it's very encouraging to see this 82% rise, okay? So let's keep going, Danielle.
I just wanted to talk about this graph because this graph basically what we know is Amazon is the biggest cloud provider right now. It has the highest market share, and Google comes second or third. Like it's a tough race between Alphabet and Microsoft. However, if you see this blue line. This is Alphabet's cloud growth versus Amazon's. So Alphabet's cloud growth in this quarter of Q2 was 82%, whereas Amazon's is much flatter than Alphabet's cloud growth. We know like Amazon's numbers are due to come out, but still Alphabet's cloud growth is phenomenal. This 82% of cloud growth is phenomenal considering how it used to fare previously. So that's the first thing that's very like impressive about Alphabet. When the market talks about getting a return on investment, they're forgetting the fact that cloud revenue is what the company is investing into mostly, and they're getting a good return on investment on that. However, what Wall Street discounted was, okay, your overall earnings per share were lower than what was expected out of you. Yeah. So, there's an as far as the second point is concerned about their capex. So they increased their capex, and their full year guidance is 195 billion to 205 billion, and that's up from 180 to 190 billion. The reason for that is what the management said is they're supply constrained at the moment. So right now they're struggling. It's mentioned over and over again that demand is not a problem. When they're expanding capacity, the reason that they're investing so much is they're seeing so much demand, and they're seeing it like far out in the future. That's why they're investing. They're building more cloud data centers. They're building um, more of their AI infrastructure in order to cater to the demand. That's why like it's not a luxury investment right now. It's out of necessity. This investment is a necessity investment at the moment.
So
Because
Daniel, they have so much demand for their cloud business that they have to spend this in order to meet the demand, correct?
yeah, they have to meet the demand. Yeah,
Okay,
they
so
have
here's
so much. Hmm.
sorry, go ahead.
Yes, there's so much of demand at the moment that they have to meet this. Now, the question that everyone that would come in everyone's mind is like, if they have so much demand, why is there a question about ROI? So there's a question about ROI at the moment because they are doing all of this capex, but Wall Street is not sure if this demand is going to uphold. That's the question at the moment. Okay,
That's the question.
if you're gonna if you're gonna build out infrastructure that's gonna like cater to demand far out in the future, will demand uphold as well? That's the question at the moment. Okay, and Alphabet would have to like show continuous improvement for Wall Street to be certain that whatever investment they have made is generating fruitful returns. Right now, that's the question. The other thing, it's not about it's about capex and earnings per share, but the most important thing is let me get into that. Yeah, this probably this and it addresses the concern that Wall Street has at the moment. It's like, and it's not, it's a very important it's a very important article, and it not only talks about Alphabet, but it talks about the entire Mac 7. So Alphabet's earnings could be a bad omen for big tech. How? The only reason is they are spending so much of capex that their free cash flows are negative right now. And when once you discount the free cash flows back to the present moment, that's when you come up with the intrinsic value. The the thing that this article is flagging at the moment is you could see the same thing happen with other Mag 7 stocks, the likes of Meta Platforms, Microsoft, and Amazon. They're going to come up with good numbers, revenue and earnings wise, but they're going to spend more. And who's going to be the beneficiary of those investments? All the entire chip stack sector and all of the companies that are helping build this infrastructure. So
So,
this is
i.e., let's say, for example, Intel, NVIDIA, they'll be the benefactors. Taiwan Semiconductor, uh, Marvell, Micron, SanDisk, they will benefit from all this CapEx spend. So the reason the CapEx spend is still a debate, guys, is because, again, Wall Street doesn't know yet. And what they're concerned about is, okay, so they're spending, they said between 195 and 205 billion for the year, okay? We're going to look at the numbers a bit more in detail, but what did Alphabet actually make in profit this quarter? Well, they made about 40 billion, okay? 40 billion. Google made 40 billion in profit this quarter. If you take 200 billion, the midpoint between the capex spend at 200 billion, divide it by 4 quarters, what are you looking at there? Well, you're looking at 50 billion per quarter. That means they are spending all the money, the free cash flow that they are making, plus some more. So they are in negative free cash flow territory. And again, Wall Street isn't sold yet, saying, okay, well, hey, you guys are going to make a huge amount of money off this because it hasn't quite come to fruition yet. And this is something that's affecting all of the Mag 7 stocks. The less I would say the least one I would be Apple. Apple seems to be a good place to hide for people right now because they're not spending anywhere near that much on capex. But as far as the rest of the companies are concerned, it's affecting every single company, and probably going to see that with Meta earnings, with Amazon earnings, and Microsoft earnings coming up. Probably going to see a very similar theme.
Yeah, but like
This,
one thing I wanted to say is like it's not that they're spending money foolishly. It's because they're capacity constrained at the moment. The demand that they're seeing, they're not able to fulfill capacity. So one they're left with two options basically. You see a lot of demand and you do nothing about it. You say, okay, we are not going to invest so much. We're going to have a free cash flow with us. And what we are going to do is like we're going to like get revenue what we get, and we're gonna distribute the remaining like whatever cash is left, we're gonna distribute that as dividends or do a share repurchase, and we're gonna reward shareholders. The other option is we are seeing so much demand, we're gonna build out more like, infrastructure because we're gonna cater to more demand. We want to grow, and in the meanwhile, we'll take the pain. We'll not distribute earnings back to shareholders. We would be having negative cash flows because we are building out for the future. The stock price might suffer in the moment, but in the long run, we'll do well because we want to compete. These are the two options that a company has. I think most of these companies are going with the option two. The Wall
well,
Street,
it seems like they all are. Just Wall Street
yeah.
isn't convinced yet. That's all.
Yeah, Wall Street, not Wall, Wall Street does not like this like non-distribution of cash to shareholders. Like investors don't probably like because there's a conflict between short-term versus long-term gains. Investors are mostly short-term in nature. Like whatever they want is like right now, instant gratification kind of thing. What they want the
Hmm.
price to go up right away. They want their returns. They want to recoup their returns right away. But the ambitions of the company are long term. They want to grow and they want to compete with every company. They want to get as much market share as possible. So there's the conflict lies here. Right now, the company is doing what's best for itself, and that is to grow and to compete with the likes of Microsoft and Amazon. Well, I'm talking about Alphabet in particular at the moment. Okay, it wants
Hmm.
to compete with the likes of Microsoft and Alphabet and Amazon in the cloud space, and also with other companies in other segments that it's dealing with. However, in the short term, it won't reward investors because you're not left with any cash flow to redistribute in terms of dividends or share repurchases, and
Well,
that's what Wall Street does
you've
not
got
like.
negative, Daniel. You've got negative cash flow. That's
Yeah,
the
and
issue.
that is what Wall Street won't like in the short term. So there's a conflict going on, and this is a classical finance. This is a classical finance concept when there's a conflict between shareholders versus um, the company itself. So what is astute investors do? They know that the company is building out for the future, and they recognize this fact, and they stay put with these companies because they have seen what they have done like in the past, the returns that they have recouped for the investors in the past, they would stay firm with these companies. Now, other investors who are short term in nature, they would flock onto stocks that are earning, that are like that are gaining in terms of share price, and they are paying back to investors in the short term. They would flock to those stocks. Luckily, we do both. We have value investments and we have those investments that are gaining, like right now, that are like earning in the moment as well. But like what I'm trying to say, it's a classical this equation right now. It's becoming more and more, I would say, prevalent. It's becoming more and more, I would say, visible that there's a clear divide between what investors want versus what the company is doing. And I think, in my opinion, the company is doing best for itself because it wants to grow, it wants to compete, it wants to be at the top, and it wants to at least retain the same market share that it had before. And the only way to do that is to invest in the future. Because the way I see it, either you grow or either you like go down. There's no in between. Okay, the company wants to grow and it wants to spend a
Apple
lot of
seems to
time.
be taking the in-between approach. Well, not even in between, the more cautious approach. They're not spending a lot on CapEx. They've got their steady business. They're looking at a small adoption of artificial intelligence. So Apple is the outlier here in this scenario,
Yeah,
and that's
but
why
but
also their stock is holding up quite well in this whole pullback.
yeah, but like it's the outlier, but it's losing ground in my eyes because like it used to be the biggest market
It
cap
used to,
company two
yeah, it
years
used
or
to be the
3 years
biggest
ago.
innovator too, right?
Yeah,
Now it's
it used
not.
to be. Now it's falling down the pecking order. So like although it's staying put in terms of stock price and it's like a stable, it appears to be a stable stock. But if you fail to innovate and you don't get in this race, I think like sooner rather than later you will keep falling down the pecking order. I don't think it's a very popular stock among top hedge funds at the moment. Apple. You would have that as a stable stock, but like in terms of innovation, yeah, it's not doing as well as these companies at the moment are suffering short term because they're investing for the future, but this is like what this is the normal course of events that go on when you're like investing for the future. But in my opinion, these companies would see reward after some time. I wanted to like talk about this as well. It's just a short term versus long term kind of thing. It isn't just higher spending troubling shareholders. The spending is eating into free cash flow. Alphabet reporting negative free cash flow for the quarter of 5.9 billion, driven by investments in capex. Analysts now expect Alphabet to report a third quarter free cash flow of 452.7 million, significantly lower than estimates of 7.69 billion analysts had before last night report. So it's going to be the free cash flow for Q3 is also going to be lower than expected. But I'm going to reiterate this fact that it's because of the fact that they're investing into the future. So it's a short term versus long term kind of thing. Okay.
So can you guys understand why Wall Street's discounting this? Because Wall Street's not convinced that this is going to pay off. That's the bottom line.
And it's not rewarding investors in the short term.
It's not, yeah, it's not rewarding investors in the short term. You're a company like Google. This is the first time Google, since its IPO, has gone into negative cash flow territory, free cash flow. First time. So they're saying, hey,
Yeah.
you're going into negative free cash flow territory to build out this AI infrastructure. We're not even convinced on this AI infrastructure. That means we're going to have pretty much no profits or negative free cash flow for the next year. And who knows what your 2027 capex is going to be? What if you increase capex in 2027 to 250 billion from the
They
200
are
billion
going
this year?
to. They are going
I
to.
think they're going to as well.
Yeah.
But these are the concerns Wall Street has. Now, your job, our job, is to look beyond that. Okay, so we're looking beyond that. If they're saying all this capex expenditure is being done, do we think there'll be a material return that'll be long lasting and sustainable for all this capital that's being spent? Because sometimes companies do spend, and we look cited the examples of Meta and Apple. Sometimes companies do spend on things that don't come to fruition, that wind up being a complete waste of money. So I hope you understand, although the results were really, really good, these are the concerns of Wall Street. And these concerns are not going to dissipate until we see some tangible earnings from all this capex spend. Okay, let's keep going, Danielle.
Yes, one thing is like metric wise, a lot of their metrics were positive, especially when it comes down to like their investments into AI. Their cloud revenue growth has been phenomenal, which is 82%. I haven't seen like 82% cloud growth ever previously in my life.
No.
And they're investing into cloud basically.
And
They have
Gemini
been
has 950 million active users. Okay, so AI,
Yeah,
so it's
so
I
like
should,
950 million active users, and like the CEO said, the AI mode has topped 1 billion monthly active users. So like it's wherever it's spending right now, it's growing in those areas. Okay.
so when
Uh,
everyone does a Google search now, you see how that AI mode pops up first.
yeah.
It tells you what the AI version of it. It used to before go to different websites, different news articles, etc. Now this AI stuff pops up. So now there's a billion monthly active users in that. So you look at the last sentence there. Okay, the backdrop that helped Google search and other revenues rise 17% year over year to 63.3 billion. That's a very nice increase. But this is what Wall Street wants to see. Okay, you're getting a return on all the spend. If there's a little bit of indication, so if for this stock to basically go up, not just this stock, but others as well, particularly I would say Meta. For this stock or Meta to go up, and also the Meta research report, thanks Danielle, is up and on the
Portal.
the portal now. So if you want to take a look, and we will be going over Meta earnings when they come out as well. Um, so all this spend is starting to bear fruit, but it's not anywhere near justifiable for the amount they're spending. So in order for this stock or any other stock to go up right now, two things have to happen. One or two things, okay? One, they say, hey, we're going to slow down this capex. Instead of about 200 billion next year, let's say they come up with 150 billion. Wall Street would love that. Love it. They'd be like, oh, this is great. They're going to calm this down. They're going to go back to free cash flow territory, positive free cash flow territory. Great. The stock, they'll be buying the stock up. Okay. Or second, they show a very, very tangible result from all this capex spend. Because if you think about it, 200 billion this year, 250 billion, let's say that's next year. That's almost $500 billion. One company, Google, one company. You better be damn convinced that this is going to have a return. Because if it doesn't, all that money, all that capital they spend, all will go down the toilet. Okay? Let's keep
Yeah,
going,
and
Daniel.
it's in its earnings call, Alphabet's management said demand is not the problem, capacity is. And that is what I've been saying throughout this call. Their problem is not demand, their problem is capacity. That's why they're investing. Right now, Wall Street is just looking at this fact, okay, you're gonna have negative cash flows. Why are you investing so much? The answer is here. They're capacity constrained at the moment. They have to spend in order to cater to all the demand that's out there. And you can either sit idle and you don't do anything, you pay back the investors and like have like make them happy in the short term, or you can like grow and like compete with the likes of like whoever you're competing with. And they are competing with a lot of companies in a lot of different areas.
Let's
Particularly in
focus
cloud,
on. Sorry,
they're
go ahead,
competing
Daniel.
with particularly in cloud, they're competing with giants.
Yeah,
So
Microsoft and Amazon.
in order to compete with them, there's no other way but to like keep on growing. Otherwise, you're gonna fall down the pecking order and like they're going to take away your market share. Like whatever you have at the moment, they're going to take that away as well in some time in the future because they're
Well,
going to continue growing.
the
They're going to
market
be
itself
more,
is expanding rapidly, right? So the market size is expanding rapidly.
yeah, even that. And if for example, Alphabet has a 30% share in cloud, if they don't grow, obviously they're going to fall back. They're going to fall back in terms of technology. They're not going to be as technologically advanced as the other companies, and they're like the other companies are going to take away whatever they have at the moment. Like that 30% market share is going to go away also. So that's why there's no other option in order to like preserve your market share or even grow, you have to like keep on expanding. So right now they don't like it. They don't, shareholders are not getting rewarded, both in terms of price action, in terms of like their earn like share repurchases. But it's and they're gonna have a negative cash flow. They're probably gonna issue more shares or gonna like take on some debt in order to finance that. But that's in the short term. What they're doing for the future is like it's pretty phenomenal. And like if like numbers don't translate into that, like oh the numbers don't translate into that entirely. But if you see the most important metrics of the company, those are very positive. Like 82% cloud growth. If the company was not investing into like if supposedly if this was 2022 and you saw an 82% cloud growth, I would have probably seen a 10% rise in stock price. Okay. It's just because it's investing so much for the future that free cash flows are negative. That's why the stock price is taking a hit at the moment. Okay. They're
Daniel,
also
let's just go up a little bit. Just go up a little bit, and I'll address Harmender's question as well. Go up a little bit in terms of the cloud growth, okay? Okay, so Alphabet Cloud shows the biggest shift. So that's the biggest shift so far. Cloud remained the clearest expression of Alphabet's. A little bit further down, Daniel. Alphabet Cloud shows, yeah. Okay, revenues rose 82% to 24.8 billion. Now, Alphabet has the least amount of market share when it comes to cloud business, but the cloud business itself is increasing rapidly. Okay, while operating income jumped to 8.8 billion, a margin of 35.6. Pichai pointed out to uptake across chips, models, data, security, and agent platforms. He said nearly 90% of Fortune 100 companies now use Gemini Enterprise. So that's a huge rise, okay? But remember, the operating income for this division of the business is still only 8.8 billion. If you were to extrapolate that out for the year, and let's say you count some pretty good growth, let's say you're at, I don't know, even if you're at 12 and a half per quarter, extrapolated out some pretty good demand, pretty much good growth, you're at 50 billion. Okay. 50 billion operating income. Well, you're spending 200 and you're spending maybe 250 next year. So I hope you start to see the problem that Wall Street has with this. Now, what you're thinking is, well, these are smart people. They know what they're doing. They know how to spend the money. Wall Street isn't fully convinced of that. Harminder, hi guys. Are there any factors or risks that could dampen demand going forward? Yes, one big factor, and that is if people do not adopt AI, like if it's not mass adoption globally. If all of a sudden people say, this AI thing, and theoretically it's all great, but it's not really working for me. It's not really working for my business. It's not really helping me out. And it kind of goes by the wayside because AI is still in its infancy. The reality is it's not like, okay, most people probably use ChatGPT. Most people probably use Grok or Claude Code. I know we do. We use them all. Okay, Grok much less, but Claude Code and ChatGPT for sure, almost daily. But is it going to hit a limitation on what it can do? Is it going to have mass adoption in businesses and personal life? Right? That remains to be seen. How much adoption is it going to have? How much will it become a part of our lives? We don't know yet. So that is the biggest factor that can dampen demand, okay? And then all this capex spend will have been mostly wasteful.
I don't think that's ever gonna happen.
I don't think so either. I
It's
agree with you,
never
Daniel. I
gonna
don't think
happen.
that's going to
Never.
happen. But that's what Wall Street's concerned about, right? Wall
It's
Street
become
is,
part of our lives. Like it's never gonna happen now. Like people are like
well,
using it. Like they can't like undo. It's
agreed.
like you're like using internet, and after some like when people started using internet early in like in the late 90s or early 2000s, they were never gonna go back on not using internet. It's the same thing with AI. They're never gonna. They're used to it. It's like you're drinking water. Like you're never gonna not drink water. It's like AI is the same thing. You're never gonna go back on AI now, in my opinion.
Yeah. Yeah, I agree. And Danielle, the main thing to consider though is not necessarily that. Never gonna go back. Like, okay, I remember when the internet first came out. Matthew remembers when the internet first came out. Okay, not everyone remembers when the internet first came out. You were too young, so you don't remember when the internet first came out.
I
Okay?
know I actually like started using the internet. I understand like you guys were like older than
Yeah,
me. You
I was a
know
teenager,
it
right? So
better.
I
Yeah.
started using it in like '94. I'm like, what is this internet thing? Would have been easy. Would have been how hard would it have been to actually predict what the internet would have become? Now imagine your life without the internet. Now it would be you would I wouldn't even know what to do.
Yeah.
But I remember what a life was like before the internet. We used the yellow pages, the white pages, and there was this thing called the blue pages. That was for businesses. Okay, sorry, government. I think that was government. Yellow pages were for business. So we had yellow pages, white pages, and blue pages, and they were dropped off to everyone's home
Yeah.
every year. Okay, and that's how we knew stuff. If we wanted to find stuff out, we'd go to the library and look at the encyclopedia. And if you were really balling, well, you would have an encyclopedia at your home. Okay, if you wanted to find out what is this, okay, encyclopedia. Otherwise, your news sources were all mainstream media that you saw on a limited number of channels. So the flow of information was very, very limited. So you can't imagine going back to that world.
Yeah.
But now look at how far the internet has progressed. It's embedded in daily life. International calls used to be super expensive. Now they're virtually free. Okay? So it's the question is, okay, so we're starting to see some offshoots of good use of capital so far. Cloud growth is amazing. Google search revenue has increased. Gemini adoption. These are all very, very good signs. But Wall Street saying, does that justify you spending this much money? 200 billion and maybe 250 next year? That's the question. Okay. Magni says, hey guys, wow, talk about a throwback. Yes, that is definitely a throwback. What is your opinion? What, in your opinion, would be value stocks just to balance a portfolio?
I think these
Um,
are value stocks. These all are
Yeah,
value stocks at the
yeah,
moment.
we think a lot of the Mag 7 are becoming value stocks. Like, if you look at the earnings multiples on these companies right now, you know, if you extrapolate, if Google said, hey, no more capex spend, okay, and they get some pretty modest growth, and they're able to, let's say their free cash flow is like, let's say 45 billion a quarter. It was 40 billion this quarter. Let's say it's 45 for the next 4 quarters. That's 180 billion. Okay, what's their market cap, Daniel? About 4 trillion. Okay,
Yeah.
Okay, so what are you looking at? 22, 23 times earnings? That's
Yes,
pretty
this is a
cheap.
value price. Like, I'm not gonna say I swear to God, but like this is a value price.
Yeah, we think this is value price. But if you want Magdalene, if you want your more traditional value stocks that don't fluctuate as much, those are different, right? Those are like dividend paying stocks. Why don't you reach out to me separately if you're trying to balance out a portfolio? We can take a look at it. That might be the best thing to do. But you're going to have the likes of, let's say, an Enbridge, maybe a Canadian National Railway. If you look at the railways, they had excellent results. Okay. Maybe some of the banks, although I think they're a little bit overvalued. Those are traditionally the value type stocks that people take to put in their portfolio to balance out their portfolio. Generally, a company like who has had a long, strong history of dividend payouts and hasn't cut those dividends and are trading at attractive valuations. That's generally the way to go. But if you're looking to make a portfolio, I can definitely help you out here. Okay.
Yeah, I'm gonna pivot to Intel's earnings now. I think I we covered pretty much all of Alphabet's earnings.
Yeah.
The
Does
key
anyone have any?
takeaways, yeah, the key takeaways. I'm just gonna summarize the key takeaways. They did pretty well on their top line. They did well on their bottom line. The cause for concern right now is like they're investing so much that free cash flows are negative and shareholders are not getting rewarded in the short term. But the key takeaway is they're building out for the future. I keep saying this. We have been saying this for the past two earnings, but this is what is happening right now. They're building out of for the future. They are going to compete with the likes of other with the likes of Microsoft and Amazon, and that's the only way to go. You would see similar theme playing out with other companies as well. The only difference, how I see as how I see with the likes of Meta platforms, Microsoft and Amazon, I think those three companies are left out of hyperscalers. I'm not like Apple is also there, but Apple is not innovating that much. So I think with the common theme with these three companies is going to be similar, although their earnings are going to be on July 29th, if I'm not wrong. But the theme is going to be similar. They're going to invest, they're going to increase their capex, but one of these three companies would also do well in terms of stock price action. It's a normal, I don't know how, but it will do something. It will do better than what Alphabet did. But it's going to be a common theme with all of these companies. They're going to if one company is investing so much into capex, it's only intuitive to guess that other companies are also going to follow suit because they're going to compete with one another. Okay.
Well, it's an arms race. They all want to be the leaders, therefore they all have to spend more and more and more. The question is, are they spending prudently? So if anyone, I'll send you questions on Google. That's the main, just an overview. Again, you can see here, Google sees more ways to monetize AI. Just highlight that before we pivot on to Intel,
Which
Danielle.
one? Which one?
Google sees more ways to monetize AI.
Yeah.
Okay, so if you look at that matter, because search on YouTube still fund the company's AI build out. YouTube ads rose 13% to 11.1 billion. Google services revenues increased 15% to 94.5. So it's the search engine that's still doing it. But you can see the cloud at 24.8 billion is starting to become a larger and larger portion, right? So
Yeah.
if it keeps growing at that pace, imagine how long it'll take before it's at the services revenue. And it's very, very profitable in terms of its gross margin at 35.6. But this is
Yeah.
the larger thing. Wall Street isn't fully convinced that this whole AI thing is going to change our lives and change everything that we do. You have varying opinions. Some people think, okay, well, it's going to be part of our lives, but it's not going to be that meaningful. Other people say it's going to change everything that we do, every aspect of our life. And when you have an adoption of a new technology, these are the general questions you have. Like, I remember when the internet first came out, people are like, oh, this internet thing's not going to last, right? It's a fad, right? Like so far, that whole virtual reality world that has proven to be non-existent. But companies
Yeah.
spend tons of money on them and got nothing out of it.
Yeah, but like also but because people
Well,
never got into that.
Apple's Apple Vision headset, that was another one, right? So these are the type of things that can go wrong when you're spending these insane amounts of money.
And
But
I
this
think,
one,
yeah, I'm sorry to interrupt, but like I think like you can ascertain whether that thing is paying off or not just by looking at the fact that have people got onto that thing or not. Like if people haven't got into that thing, like they haven't like used that thing, I would say like a lot of people haven't used that thing, you know it's not doing well. Because like you have to get used to something in order for that to like keep on growing. People never got into that idea of metaverse or Apple Vision. But people quickly got onto this AI, like that these platforms, AI platforms like ChatGPT or Gemini. People quickly got onto this. Like I can't like right now, whenever I go onto this search engine of Alphabet and I like want to search something else, there's always this bar, AI bar that appears in front of me, and I want to ask for the questions from that AI bar. So I'm using it, like I'm using it instinctively now. And I think like my example is not the only example. I think like a lot of people are doing the same. So they have caught on to this, I would say, trend, and I don't see it going away.
Okay, let's pivot. Unless anyone has any questions, let's pivot to Intel. Now, Intel is one of the major manufacturers of chips and fabs. Now, they are not at the level of NVIDIA in terms of how good they are, and they're certainly their fab is not as good as Taiwan Semiconductor, but they're kind of playing third fiddle when it comes to the whole chip manufacturing. Number one would be NVIDIA, number two would be AMD, number three, Intel. Okay. So that's kind of the pecking order so far. Now, how much are they going to catch up? How much are they not going to catch up? And in terms of fabrication or fabrication plant, well, the fabrication plant now they're starting to get a lot more into production. So we saw this yesterday with Tesla's earnings, who are creating their own fab called TerraFab. What these companies are signaling is, okay, if you're building all this stuff out, fabs everywhere, more manufacturing facilities, they're anticipating a huge amount of demand for a sustained period of time as this whole AI build comes out. Okay. Ivan asks here or says here, AI will create more jobs. I just hope it takes mine away and that work will be optional. Now that's the most bull case scenario. Work becoming optional. Now, a few people, and most notably Elon Musk, has said that work will become optional once this whole AI build out is there. Why? Because the incremental cost of producing something will be almost nothing. Okay, but I'll tell you something like, okay, so who gets beachfront land? That's got to cost something, right? Because there's only a limited amount of that. Who gets, the best seats at the Jays game or the Leafs game? That's got to be worth something. But the idea is when artificial intelligence combines with robotics, you have unlimited labor, which replaces our human labor. That's the idea. Okay. Therefore, you have massive GDP growth, huge amounts of wealth created, and enough for everybody. Now, how that plays out, who knows? Theoretically, if that happens, yes, there should be optional work. But what will human beings do? I think you're right. It'll create more jobs than it'll destroy, but the transition it could be pretty painful.
Yeah, I
But
wanted to. Okay, go on,
I was
Omar.
going to say, but this build out is going to continue. Okay, and there's going to be bumps and bruises along the way. Intel, okay, again, like I said, third fiddle here, and second fiddle when it comes to the fabs. Okay, so let's dive into their earnings, Daniel.
Yeah,
They did great.
they did great. We're gonna pivot from spenders to benefactor. This is the benefactor of
But
whatever
now, Daniel, even the spenders are spending, right? That's the issue, right? Even the spenders are spending. So excuse me, the
benefactors are spending.
benefactors are spending as
Yeah,
well,
they
right?
are. They are.
So, Intel, okay. So when Google announces 200 billion of capex spend for the year, well, they need chips, okay? They need chips to be. They design their chips, but their chips have to be produced somewhere, and they have to be chips. Okay, well, who makes chips? Well, Taiwan Semiconductor makes chips. That's great for TSM. Who else makes chips? These guys. Intel makes chips. Okay? And there's going to be enough demand where they need to make their chips. Now, the problem is the capex. So the benefactors become spenders as well. Well, Intel says, well, hey, wait a second. We don't have enough capacity to make all these chips. We need to build some more factories.
Yeah.
And their capex winds up going up. And that's what happened yesterday. So let's dive into the details, Daniel.
Yeah, like their capex did go up, but there was a difference between their capex going up versus Alphabet's capex going up. The difference is it's not eating into their free cash flow, Intel's free cash flow. So that's helping Intel versus the likes of Alphabet. So it did well both on top and bottom line. Like its top line, it did 16.1 billion versus 14.42, and on the bottom line, it did 42 cents versus 21 cents. So it's almost double of what was expected. The other good part about Intel was its revenue grew by 25%, which was the fastest for any period in almost 15 years. So the turnaround, it looks like the turnaround is going somewhere. Okay. And it's after the US government took 10% stake in the company earlier, like last year. So, and the CEO said AI is driving unprecedented demand for compute. Okay. So right now, their biggest and growing segment,
Unprecedented demand for AI growth,
yeah,
for compute, excuse me.
yeah, for
Unprecedented
compute.
demand. Okay.
Yeah,
So
and
that means,
you
yeah.
would you would see this theme play out with every chip stock and with every hyperscaler. Hyperscalers are gonna say we are capacity constrained, we are spending, and you're gonna like read this and you're gonna see this same sentence being mentioned by all of these chip companies that the demand for AI and demand for compute or demand for memory is unprecedented. You're gonna keep
But
seeing this theme play out.
I'll point out this much. Okay, so let's take a look at what could go wrong. Okay, so if AI is not all what we think it's going to be, okay, what happens? Hyperscalers reduce capex or drop it altogether, okay, or let's say substantially reduce it. Then the likes of Intel, Taiwan Semiconductor, they're hurt. Then the likes of Micron, SanDisk, they're hurt. So it becomes a domino effect. But right now, it's the exact opposite. Right now, capex keeps going up for these companies. What we have to wait on exactly is let's see some tangible results from all this capex. But so far, excellent quarter from Intel. Excellent quarter.
Yeah, Intel is also doing long-term agreements. It's following the same theme or the same idea that Micron started, that they're going to do long-term agreements. They're going to lock in prices. So it's not like after some time, if there's like a volatility in demand, Intel might not suffer because it's going to lock in long-term customers. It's already done 10 customers. One thing the Wall
Just
Street
here,
was looking.
customers continue. Just go up a bit here. Just customers continue to signal a strong and sustainable spending environment. That is a very good sign.
And this is despite this inflationary environment. Okay, I don't think inflation has seeped into these components like compute and chips, but still, despite inflationary environment, because inflation is everywhere else, right? You're spending money on other things. But despite that, people are not cutting back on their spending into these chips and building their infrastructure, AI infrastructure. So even despite the fact that inflation is on a rising trajectory in the past few months, it's not impacting their AI spending on these chips and all the other crucial components that are needed to build out the AI infrastructure. Apart from this, the first things first, Intel's main revenue driver is still the client computing group, which makes chips for PCs. That grew by 13%. But what the market is looking towards are two things. First is their data center business. So that revenue grew by 59%. So
Huge growth.
that's huge growth. Okay. So that's where the turnaround story starts. And the other thing is their foundry business. So with the chip business, they were doing well with the 18A chip, but now they're coming up with their latest 14A chip. That's 2 nanometers. Okay. Now the only thing that remains to be seen is whether this chip can compete with TSM's 2 nanometer chips on a lot of parameters. But if it's able to do that, then Intel is good to go and it'll find customers for its 14A chips.
Now, who will make these 2 nanometer chips, Danielle? Because we know that Intel doesn't have the technology, only TSM does.
Yeah. To some degree, Intel does not have the capacity. It does have the technology, but it does not have the capacity. So it's gonna like outsource some part to TSM and it's gonna do some part itself, but it does not have the entire capacity to like fulfill the entire demand.
Yep.
Okay, so it's foundry business. That's the second most important thing that's being looked upon by Wall Street. Foundry reported 5.8 billion in sales. That's up 31% on an annual basis. So 31% is also good growth considering its foundry business was dead 1 or 2 years ago. So it's growing now. Okay. Now, what the Wall Street was looking forward to was Intel naming its foundry customers, like which customers are becoming its foundry, like which customers are going to buy chips from its foundry business. Intel did not give many names. It gave one name, that's Fortinet, that Intel has landed this company. But we do know, like in this past quarter, Apple has also reached out to Intel for its foundry business. So Apple is going to be another customer, and the other customer are also going to follow suit. The third most important thing was Intel is also manufacturing custom chips for the likes of these hyperscalers. So we knew like Broadcom and Marvell were doing that thing, but Intel is also doing that thing. So Intel is designing custom chips for these hyperscalers like Alphabet and Amazon. So because of that, Intel also got a run rate. Intel also got revenue out of that as well. It's mentioned in one other. I will share that article, but it's mentioned in another article. Intel said that the run rate for that is $2 billion. So $2 billion is not a small amount. The last most important thing with Intel's earnings was its gross margin. So its gross margin also recovered to 42%, up from 2.5% in the year ago period. So it's up from 2.5% to 42%. Gross margin was the single most important metric in terms of like its financials that the company was looking towards improving, because it was like it had become a very inefficient company. Now the gross margin has reached 42%. So in my opinion, these earnings are phenomenal. Like in terms of every like, because Intel was a turnaround story and it's turning around. It's growing in its data center business, which is the chip business. It's growing in its foundry business, and the more foundry customer it finds, the more competition it's going to give to TSM, and it's going to keep growing. Lastly, its gross margin also improving. So we all know that TSM is the biggest foundry manufacturer in the world, like chip manufacturer in the world. TSM for me is not a value stock. TSM is a growth stock. It's growing and its value is justifying that growth. But Intel, I know I have said like all of these hyperscalers are becoming value stocks, but Intel for me is also a value stock because it's a lot of the value is still unlocked. Okay, because it's growing and these growth numbers are not just these are not being justified by the stock price at the moment. And Intel does not like compete in only one category. It competes in a lot of categories. It competes with AMD and ARM in the CPU compute space. It competes in the foundry segment with TSM. It also competes in the custom chip segments with the likes of Broadcom and Marvell. It is also dealing in advanced packaging. So Marvell and Broadcom also deal in that. So it's competing with a lot of different players in this chip manufacturing space. But these are like different in different, I would say, segments. Because of that, Intel has a diverse revenue stream. Whenever we look at a company, we also look at the fact that what's the diversity of its revenue. If there's a lot of diversity in revenue, that's considered as positive because you're not relying on only one thing for your revenue generation. You're relying on a lot of different things. And if you're relying on a lot of different things, that's good because even if demand falls on one side, you're still good on the other in the other segments as well. In the other segments, and that's always thought of as a good thing for the company. So for me, Intel is still a value player. Although it went up to 140, right now it's trading around $100. It's a value player because there's a lot of value that remains to be unlocked with Intel.
Danielle, the million-dollar question is why is this stock down so much then? If it's everything
Today?
is so good, so not just today, post earnings. Okay, so post earnings, they did everything right,
Yeah.
but we didn't talk about their capex spend yet.
Yeah, we didn't talk about their capex spend. It's mentioned here.
So this
They're
is
gonna
again
spend.
the same thing that's afflicting all these companies, also is afflicting the now benefactors of this. So they decided to also say, hey, we need to build more stuff. We need to build more factories. We are going to increase capex. Okay, so 2025 baseline, 2026 outlook, as you can see here, total capex 20 billion. Okay, greater than 20 billion. Look at 2027, significantly above 2026. Now, what that means, who knows? Okay, so let's take a look at a bit more detail into capex. In a striking show of optimism, Intel raised 2026 capex expenditure forecast to more than 20 billion, a significant increase from earlier plans. With tooling spend alone up 40% from 2025, the company also flagged that 2027 capex will be significantly above 2026 levels, predominantly spent in the US and supported by the CHIPS Act's investment tax credit. Now, that means the US government, who took a 10% stake into Intel, wants to see domestic manufacturing of chips because if something goes wrong with that TSM factory, the US is going to find itself in a world of pain. They don't want that. So they're trying to build these factories as quickly as possible, and they're giving tax credits to chip manufacturers like Intel. And Intel is building these chip manufacturing facilities, these fabs, as quickly as they possibly can. But Wall Street looks at it and says, hey, wait a second. Now you guys are spending more money too? We still don't even know if AI works. And you guys are spending more money now. You know, the hyperscalers, the Mag 7s are spending more money now. You guys are spending more money. Next, it'll be NVIDIA. It'll be TSM. Like, it goes on and on and on and on. When are we going to see tangible results for all the spending? Now, next year, I think this CapEx spend across the board, it's probably going to be well north of $1 trillion. Just think of that in 1 year. Okay, 1 year. That's that's pretty insane, right? So that takes away almost, not almost all, but a significant portion of the free cash flow of these companies. And Wall
Yeah,
Street
it
doesn't like
does.
that,
It
right?
does. It
And
does.
that's
And
the
like
problem.
Intel has also helped with this CHIPS Act, so they're gonna get
Of
some
course.
grants when they're investing. However, the article says CapEx surge signals long-term conviction. Intel is convicted that it's gonna like there's demand out there. So whatever they're spending on, there's demand out there. Intel right now, and what I see, if you saw the stock price action after the earnings, the stock price went up by 10%. However, it fell after that. The reason was it announced capex. It still was up before today's market
Well, it went
start.
up right after the earnings announcement because the earnings were great. But once it had the earnings call, which is an hour after the earnings announcement, in the earnings call, they said again 2026, 20 billion, 2027 significantly above 2026. Wall Street said, I don't like this, right? You're going to be cutting into all your cash flow again, just like the hyperscalers are. And the
Yeah,
stock got hit. Now, the question for you to ask yourself is, do I believe in this? So if you invest in something, let's say like an SMH, which is a chip ETF, or if you invest in this company directly or the Mag 7s, you have to ask yourself a simple question. Do I think this is all going to bear fruit? If you do, could be an excellent entry point long term. But all indications look like these are good. They believe in what they're doing. Otherwise, why would these companies spend so much money? They believe in what they're doing. It's not one of them, it's across the board almost. So we're in a good spot that way because they certainly do believe in it. Now we can also see anecdotally with our eyes. We can see, hey, look, the people I know, myself, we're using this technology. We use AI all the time now. Where is it headed from here? How much more productivity is it going to give us? We don't know yet because we're at the beginning stages. So I hope you have a better idea as to how the stock market's viewing this versus what's actually happening because the results, you look at the results are great. And the backdrop of all this is this war and higher inflationary. That's the backdrop of all this. If we didn't have that, there's a decent chance we move quite a bit higher from here, but we do have that. So we're gonna have to see how that plays out. Danielle, anything to add here?
no, I think we've covered everything, but I just wanted to reiterate this point that the stock price went up by 10%. After earnings, the stock went down to like 1 or 2%. Before today's market start, the stock was up 4%. It was at 104. Now the stock is trading downward, and it's nothing to do with the fundamental of the company. It's like more to do with like what's happening on the geopolitical front. Like the entire chip sector is selling off, and Intel is also, I think, is caught in line. It's because of the geopolitical events going on, and like the entire Nasdaq is down, and Intel is also feeling the heat. Um, I think like when the stock market normalizes, you would see like Intel would probably do well because like on the earnings side, it did well. It's living up to its turnaround story. And I see two sides right now. One is one side is the spenders. All of the companies are spending and their free cash flows are negative. The other side are the benefactors, and Intel falls in the benefactor side. So as soon as the market normalizes, these benefactor stocks are going to do well.
Okay. Well, again, guys, just to reiterate, these companies seem to be pretty convicted. Otherwise, they wouldn't be spending this much money. Wall Street simply doesn't like that short term. And it's going to be a wait and see kind of approach. We
Yeah.
really, like, as much as we think we know AI is going to change our lives in a significant way, and I truly believe it is, uh, we have to see exactly what that means for profitability and how it all plays out. So, unless there's any last questions, thank you so much for joining us. Have yourselves a great weekend. Take care. Bye bye.
Take care, everyone. Bye.